Welcome to the Explainer. Today, we are undertaking the absolute ultimate stock analysis. We're going to put CVR Energy, ticker symbol CVI, through what I like to call the Guru Gauntlet. We are going to rigorously test this stock using Wall Street's greatest, most legendary valuation models. We've got the data, we've got the frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and we're going to see if this company can actually survive the gauntlet. All right, let's dive right in. Here's our roadmap for today. 1. The company snapshot. 2. The Warren Buffett lens. 3. The Peter Lynch lens. 4. The Benjamin Graham lens. 5. DCF and alternative valuations. And finally, 6. Synthesis and final verdict. Section 1. Company snapshot. Let's get grounded. So CVR Energy trades on the New York Stock Exchange under the ticker CVI, and it's currently priced at $33.46. They operate in two highly cyclical segments: petroleum refining, with facilities in Coffeyville and Wynnewood, and nitrogen fertilizer, through their stake in CVR partners. But the real elephant in the room here, and this is a fascinating dynamic, is that 82% of the company is owned by billionaire activist Carl Icahn. Recently, the company reported a pretty brutal first quarter for 2026, taking a net loss of $160 million, or about $1.91 per share. And yet somehow, despite this massive loss, management just declared a 10-cent per share dividend. Now, you might be wondering, what's going on with operations? The macroeconomic backdrop actually wasn't terrible. Their crude utilization was fantastic in Q1, hitting 97% with a combined throughput of 214,000 barrels per day. Even the benchmark NYMEX crack spreads, which is the margin they make refining crude into products, averaged a really solid $21.58. So why the massive loss? One word: regulations. They were absolutely crushed by a $143 million expense for RINs, renewable identification numbers. That is a whopping $7.37 per barrel penalty just for EPA compliance, and it completely destroyed their capture rate. Moving right along to Section 2, the Warren Buffett lens. We know Buffett looks for a deep economic moat, consistent earnings, and manageable debt. So does CBI have a moat? Not really. They're a classic commodity price taker, meaning they just sell refined fuels and fertilizer at whatever the market price is. Plus, that massive $143 million RINs expense proves they're totally at the mercy of EPA regulations. Now, as for management, they are actively focusing on a $1 billion gross debt target, which Buffett would definitely appreciate. But the earnings? They are all over the place. You simply cannot post a Q1 loss of $191 per share and expect to pass Buffett's test for predictable, boring, compounding earnings. And the unpredictability bleeds right into their cash flows and dividend history. Look at this roller coaster. In 2021, they paid out $2.49. Then it drops to $1.70, bounces back up to $2, gets slashed to $1 in 2024, and is projected to plunge to just 37 cents in 2025. Buffett loves his dividends, sure, but he demands steady, reliable payouts. These volatile, special dividend-driven payouts are entirely tethered to commodity cycles. It completely fails the consistency test. So if we calculate Buffett's favorite metric, owner earnings, we look at their projected 2026 free cash flow, which analysts peg around $298 million. Let's just round up and call it a normalized $300 million. Given the extreme cyclicality and those looming regulatory risks from the EPA, Buffett would demand a massive margin of safety here. Honestly, he likely wouldn't even bat an eye at this stock unless the price dropped heavily, definitely below $15 a share, just to compensate for all that unpredictability. Section 3. The Peter Lynch lens. Peter Lynch would take one look at CVI and immediately categorize it as a cyclical play. And as we know, you don't buy cyclicals and hold them forever. You trade the cycle. Lynch would actually love their balance sheet right now. They're sitting on $923 million in total liquidity and $512 million in consolidated cash. Furthermore, Lynch absolutely loves stocks that institutions ignore. Because Carl Icahn owns 82% of the entire company, the institutional float is incredibly low, leaving Wall Street fighting over absolute scraps. To Peter Lynch, combining a strong balance sheet with low institutional ownership is actually a fantastic setup. But what about the valuation? Lynch's favorite metric is the PEG ratio, price to earnings relative to growth. Because current EPS is negative, we have to make some assumptions to fill in the data gaps. Let's look forward to the projected 2027 EPS of $1.70. If we assume a normalized 10% cyclical growth rate for a recovery phase, we get a PEG ratio of 1.96. For Lynch, anything over 1.0 is getting expensive, and climbing near 2.0, that is definitely not cheap enough to justify pulling the trigger. The crucial point here is how Lynch trades cyclicals. It's totally counterintuitive. You actually want to buy them when the PE ratio looks artificially high, because earnings have completely bottomed out. CVI is currently showing negative earnings, but the stock is still stubbornly sitting at $33.46. Lynch's verdict would be a firm hold or even a sell right now. He would tell you to sit on your hands and wait for the absolute bottom of the earnings trough, when the stock gets indiscriminately dumped, before even trying to catch this cyclical play.
Okay, round 4, section 4, the Benjamin Graham lens.
Graham, the father of value investing, uses a notoriously strict defensive investor checklist. Let's see how CVI holds up. Adequate size? Yes, it's got a $3.4 billion market cap? Pass. Financial condition with $923 million in liquidity? That's an easy pass. But then we hit a brick wall. Earnings stability? Fail. They've got negative 2025 and 2026 EPS. Dividend record? Fail. It's been slashed. Moderate PE? Fail. You can't exactly have a moderate PE with negative earnings. Graham's checklist violently rejects CVI in its current state.
But hey, let's give the stock a fighting chance, using Graham's famous intrinsic value formula. As a reminder, the formula is the square root of 22.5 times earnings per share times book value per share. Because of the current data gaps with those negative earnings, we have to plug in some assumptions to make it work. We'll use the optimistic 2027 EPS estimate of $1.70. And for book value per share, we'll just assume an industry average of $15. When you crunch those numbers, the square root of 22.5 times 1.70 times 15, you get a Graham intrinsic value of $23.95. Remember, the stock is currently trading up at $33.46. That means there is absolutely zero margin of safety here. To even consider buying this, Graham would require a purchase price roughly 2/3 of that intrinsic value, which means he literally wouldn't touch the stock unless it plummeted down to around $16. Moving into modern Wall Street territory, Section 5. DCF and alternative valuations. Let's build out a discounted cash flow base case. We have to explicitly state our assumptions here. We'll start with the estimated 2026 free cash flow of $298 million. For the 5-year growth rate, we're assuming a flat 0%, essentially modeling a cyclical plateau. We apply a 10% weighted average cost of capital, which is standard for this kind of risk profile. And for the terminal growth rate, we also assume 0%. Why? Well, the refining sector is highly mature. In fact, CVI actually just ceased renewable diesel production at their Wynnewood refinery and converted it back to hydrocarbons because the economics were so bad. So realistically, long-term growth is flat at best. Now look at this DCF sensitivity table. If we assume a slightly worse case, say negative 1% terminal growth and an 11% WACC, the fair value drops to just $22. Our base case of 0% growth and 10% WACC gives us a fair value of $25. And get this, even in a highly optimistic scenario with 1% terminal growth and a forgiving 9% WACC, the model only spits out $29 per share. The DCF model simply cannot justify the current $33.46 stock price no matter how much you tweak it. And the alternative models? They completely confirm this pessimism. If you run a dividend discount model, well, because the dividend was slashed to a normalized annual rate of roughly 40 cents, the valuation collapses down to around $4. Meanwhile, if you look at the consensus from 6 Wall Street analysts, their average price target is $28.80, and they've slapped a consensus sell rating right on the stock. Which brings us to our final stop, Section 6, Synthesis and Final Verdict. When we line the whole shebang up side by side, it paints a glaringly clear picture. Buffett needs it under $15, Lynch says hold and wait for the absolute bottom, Graham calculates an intrinsic value of just under $24, our DCF base case lands right at $25, and Wall Street consensus sits at $28.80. Every single valuation framework, without exception, points to a fair value significantly below the current trading price of $33.46. Now, to be fair, let's play devil's advocate and weigh the bull case against the bear case. The undeniable strength here is their fertilizer segment. They're running at a blazing 103% ammonia utilization, they've got massive backing from Carl Icahn, and global supply chains are tightening, which could definitely boost margins. But man, the risks are just suffocating the refining segment. You've got those punishing $143 million RINs expenses, negative current earnings, and highly unpredictable, volatile dividends. So what is the final verdict? CVI definitively fails the Guru Gauntlet at its current price of $33.46. Across the board, looking at every model, it is a firm sell. But here is what you should really take away from this. Cyclicals overcorrect. They always do. If a market shock or continued regulatory pressure pushes this stock all the way down below $20, it suddenly enters deep value territory. The question is, if it gets there, would you be brave enough to catch this falling cyclical knife? Think about that, and definitely keep this one on your watch list for the next cycle. Thanks for joining me on this explainer, and I'll see you next time.